This chapter examines markets where there are many buyers and sellers. We will cover the topics listed here. We will assume that firms wish to maximize profits. Profits are total revenue minus total cost. If you have total control over your market, you would like to set your own price, the quantity you produce, and keep costs to a minimum. Not all firms have this luxury. In a competitive industry, one firm's product is like another's, so they're homogeneous. And there are lots of sellers and buyers. If the price of wheat is $1 per bushel, Farmer Jones can't sell his wheat for $1.25 because buyers will only pay the market price. Where does this come from? Let's look at the market for oil. In the overall market, the price of oil is $50 per barrel. If I have several oil wells on my land, I effectively face a perfectly elastic demand for my oil at the price of $50. That is, I can sell all the oil I pump for $50. Here's the example I discussed earlier. If I charge more than the market price, I don't sell anything. If I charge at the market price, I can sell all of my wheat. I can also sell all of my wheat below the market price, but that would mean I would lose money, which I do not want to do. So my demand curve is flat. Here are some definitions. Profit, we use the Greek letter pi, is just total revenue minus total cost. Total revenue is price times quantity, and total cost is made up of two parts. We have fixed cost, or costs that don't change when you increase output, and variable cost, costs that do change with output. So total cost is fixed cost plus variable cost. So think about fixed cost. These would be the cost of the building, for example. It's fixed no matter how much output you produce. But if you want to produce more output, you might have to hire more workers. That would be a variable cost. Since a firm in a competitive market must sell its output at the market price, profit maximization depends only on the firm's output decision. They don't get to choose their price. When producing another unit of output, the firm will incur extra costs and gain extra revenue. Profit maximization is about comparing the extra revenues to the extra cost at the margin. So we look at marginal revenue, which is the change in total revenue from selling an additional unit, and compare that to marginal cost, which is the change in cost from producing an additional unit of output. So the quantity that maximizes profits will be the quantity where marginal revenue equals marginal cost. The reason is, if marginal revenue is greater than marginal cost, producing more output will add to your profit. That is, you are adding more to your revenues than your cost for producing that unit, so you will want to produce more. For example, let's say you're producing 10 units and the marginal revenue of the 11th unit is $5 and the marginal cost is $4. Then by producing that unit, you have increased your cost by $4 but increased your revenue by $5. Thus, you have a net gain. If marginal revenue is less than marginal cost, producing less will add to your profit. Since marginal revenue is equal to price for competitive firms, then the profit maximizing rule is just price equal marginal cost. Graphically, marginal cost will rise. That is, each additional unit of output is more costly to produce. Our marginal revenue is constant and equal to the price for each additional unit that we sell. Our revenues increase by the price. Notice, when we produce the first unit, we add more to our revenues than we add to our cost. For example, our cost increases by $5, but our revenues increase by $50. This is true until we reach the 8th unit. So graphically, marginal cost will rise. That is, with each additional unit of output, it's more costly to produce. So our marginal revenue is constant and equal to the price. For each additional unit we sell, our revenues will increase by the price of $50. Notice when we produce the first unit, we add more to our revenues than we add to our cost. For example, our cost increased by $5, but our revenues increased by $50. This is true until we reach the 8th unit. At that point, we add $50 to our cost and $50 to our revenues. All the previous units increased our profits. Note the 9th unit adds about $70. Note the 9th unit adds about $70 to our cost, but only $50 to our revenues. In other words, we lose $20 if we produce the 9th unit. So we only produce to the point where marginal revenue equals marginal cost. Now, if price were to increase to $100, it now becomes worthwhile to produce additional output, and now it becomes worthwhile to produce additional output. We will produce, it looks like 9.5 units in this example. So to determine the profit, we want to determine our total revenue and our total cost. On a graph, we can examine average cost. Average cost of production is just total cost of producing Q units divided by that quantity Q. In a table, let's assume we have the following numbers. The marginal revenue is $50 for every unit we produce. At 8 units, marginal revenue equals marginal cost. Notice that the profit is highest at that point, $194. Also notice that as output increases, the change in profits starts to decline. That is, each additional unit of output adds a little less to profits. As long as the additional unit of output adds to profits, we want to produce it. Graphically, we produce where marginal revenue equals marginal cost at 8 units. We know that average total cost at 8 units is $25.75, and the price is $50. So, since profit is total revenue minus total cost, and total revenue is price times quantity, total cost is average cost times quantity, then we take price minus average cost times quantity, and that will give us our profit. So in the graph at 8 units, the average cost of $25.75 and a price of $50, the difference between those two gives us the green rectangle, which is our profits of $194. For profits to be made, total revenues must be greater than total cost. And that implies that price has to be greater than average cost. If we look at this graph, and the price is $5, then we would want to go from $5 and across to the marginal cost curve, and then we go down, and it looks like 14 units is the quantity we would want to produce. And so this is how we find the quantity. And at $14, what is the profits? Well, we do the same thing again. We go across, not a very straight line, and down. So we've got 14 units at $5, and it looks like the average cost is about $4. So the difference between price and average cost is $1. So that's our profit per unit. So 14 times $1 gives us a $14 profit. The above result that we see is just a mathematical fact. So you can read these. Think of it this way. If on the next exam the average is 80, but one student misses the exam, well, what happens when she takes the exam? Let's say when she takes the exam she makes a 90. What happens to the average? it goes up. If she makes a 70, the average would fall. And if she made an 80, the average would be unchanged. And so that's what this is telling us. Same thing. So firms will make a profit if price is greater than average cost. If this is the case, other firms will want to get in on the action, and new firms will enter the industry. If price is less than average cost, some firms will be losing money. All firms will be losing money. So some firms will leave the industry. Entry and exit occur until price is equal to average cost. At this point, there is no incentive to enter or leave the industry. Economists refer to zero profits as normal profits. The idea of zero profits is important. The idea of zero profits is important. In economics, all opportunity costs are covered when profits are zero. So if you invested in your company, you're making a normal return on that investment. Economic profit will always be less than or equal to accounting profits. In accounting, only explicit costs are included. Because accounting does not include implicit costs such as foregone rent on a building you might own, their costs will be lower and their profits will be higher. Here's an example. If you quit your job as a line tamer at $45,000 a year to open a tanning studio and you have $45,000 left over after your costs are paid, what's your economic profit? Well, we would say your profit is zero. You're earning just enough to cover your cost, including your foregone earning as a line tamer. Think about this question. At the end of the year, Alex pockets $5,000, $15,000 in revenues minus $10,000 in interest cost, while Tyler pockets $15,000. It's tempting to conclude that Tyler's well-made is more profitable, but that would be a mistake. Tyler would have left his $200,000 in the bank, and at a 5% rate of interest, he would have earned $10,000 a year in income. Tyler's opportunity cost is $10,000 in income he gave up when he invested the money in drilling the oil wells. Thus, once we take into account all the cost, including opportunity cost, Alex and Tyler's wells are equally profitable. Other examples of implicit cost include foregone rent, if you're using your own building for a tanning studio, for example, foregone interest income if you're using your own money, and many others. You need to consider these costs if you want to make good decisions. So from now on, we'll assume that all of our costs take into account all of these opportunity costs, and therefore a zero profit is not a bad thing. Should a firm shut down if they're making a loss? It depends. A firm will always have to pay its fixed cost. If it operates and can cover all of its variable cost, and have a little left over to pay some of the fixed cost, then it is better to operate and pay a smaller portion of fixed cost out of pocket than to not operate and pay all of the fixed cost out of pocket. Look at this example. If he operates, his loss is $75 instead of $100. So the firm will operate at a loss instead of shutting down and losing the $100. Sunk costs are important because they cannot be recovered. So in this case, once they are incurred, a firm will ignore these costs and only worry about covering variable cost. It's an idea of you don't cry over spilt milk. If a firm could instantly costlessly enter and exit industries, then the basic rule applies: enter if price is greater than average cost and exit if it's less than average cost. But when it's costly to enter and exit and there's uncertainty of future prices, firms must make their decisions based on their lifetime expected profit. Now, this estimation can be quite difficult to make, and any error can lead to significant losses. So firms operate at a loss when they can cover their variable cost. If we consider the entry decision, a firm will enter the market as long as price is greater than average cost. So its supply curve would be its marginal cost curve above the average cost curve. If we have two firms with different average cost, then the market supply curve will be the sum of these two firms' supply curve, which is their marginal cost above the average cost. So, firm 1 produces 4 units at $17 and 6 at $29. At $29, firm 2 also produces 6 units. So, in the market, the quantity supplied is 4 at 17 and 12 at 29. The shape of the supply curve for a particular industry is determined by the change in cost as industry output increases or decreases. Remember, there's lots of firms entering the industry or leaving the industry. And there are 3 types of industry supply curves. An increasing cost industry, where an industry in which costs increase with greater output, and it would have an upward sloping supply curve. A constant cost industry is an industry in which costs do not change with greater output, which would have a flat supply curve. And a decreasing cost industry, which is an industry which industry costs decrease with greater output and would have a downward sloping supply curve. So this would be an increasing cost industry, that's a constant cost industry, and that's a decreasing cost industry. The long run supply curve is upward sloping for increasing cost industry, flat for constant cost industry. The decreasing cost industry is a special case that might occur as an industry develops, particularly if it develops in one locality. In a constant cost industry, price will equal the minimum of the average cost. If profits are being made, new firms enter the market. As they enter the market, prices start to fall, as do profits. Firms will keep entering until profits go back to zero. As demand increases, prices rise and profits will increase. So we move from here to here, so price goes from $6.99 to $7.99, and notice this firm is making a profit. Then what happens? New firms will start to enter the market, and as they enter the market, supply will increase and prices will be driven down so that profits return to zero. So notice our long run supply curve is going to be elastic, perfectly elastic at $6.99. So from the graphs above, we can say that the short run is a time period before entry occurs, and the long run is the time it takes for substantial new investment and entry to occur. This will vary from industry to industry. So how long is the long run? Since it takes time to get training, it will probably be more than 2 or 3 years. This slide gives an example of an increasing cost industry. As more firms enter the market, they bid up the prices of inputs, and as a result, their cost of production increase. Decreasing cost industries exist for a short period of time, as more specialized resources move to one place to improve the overall efficiency. However, over time, these cost advantages will likely disappear. So try this one. This is just a simple supply shifter of an increase in cost. As costs increase, supply will decrease.